and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And today on the show, we're talking about, well, how does this boom compare to previous booms that we've seen in the past? So we are in a period here in New Zealand where the housing market is really heating up. And of course, actually, we're in a period where the whole market for housing right around the world globally is heating up as well. We're seeing this in Germany and Australia and parts of Canada, US as well, and particularly Great Britain. So how does this one here in New Zealand compare to what things have been like previously? Because it does feel to some investors who haven't seen previous booms like house prices are out of control and they're continuing like they never have before.
Apart from they have.
Exactly. Now, I don't mean to demean or trivialize the need for housing, but I want to tell you a little story, first of all, about New Zealand's first major housing shortage. You've already got your notes in front of you, Andrew, so you know where this is. I can't give you the pop quiz that I'd usually like to do.
Not somewhere I would have guessed either.
No, so here's the story. I was down over New Year's in Dunedin, and I went to the Settlers Museum. Fascinating museum, by the way. And I was walking along, and I saw, what's this? Little note from 1861, and I'll read you this. Dunedin's population exploded during 1861. It doubled to 5,850 people. 3 years after that, it was 15,790. Managing the town's development was not straightforward. Housing was so scarce that many people had to live in tents, and the provision of basic services such as roads, water, and sewage was often chaotic. Now, of course, this was back in the 1860s, but I want to point it out that there have been housing shortages right throughout New Zealand's history and right throughout world's history, and people will talk about it because housing itself is so much of a need. And so whenever it's talked about, whenever there is a perceived housing shortage, it will always be talked about very evocatively or very emotionally because it's perceived that we don't have enough for everybody to go around. And so I first of all just want to talk about that emotive side and say, hey, whether we talk about the need for housing in 100 years or 160 years ago, in this case, it's always talked about emotionally because it is a fundamental need.
Actually, do you know what actually drove that population growth, Ed? I was just wondering that before.
Oh, so back in the 1860s, there was a big gold rush in the bottom of the South Island. And so we saw a lot of people moving there and infrastructure hadn't caught up. But you can actually take that same analogy and apply it to probably the last decade where we've had a lot of people move into New Zealand. Our population has increased by about 25%. We've gone from 4 million people to 5 million people, and the level of housing has not kept up with that.
And one of the interesting things is if you look at a graph of house prices going back to 1993 is when REINZ started recording this, you look at the current boom and it looks like the worst of the worst because you've got such a steep incline. Now, the reason for the steep incline is because you're dealing with higher numbers. What I mean by that is if you go back to 1993, you might be talking about a 10% increase on 100K. So it's only $10,000. It doesn't spike that graph the same way as a 10% jump in a $1 million house, which is 100K. So you can see these graphs and look at the numbers and think, wow, this looks like it's extreme. This looks like it doesn't make sense. But then as time goes on, that kind of becomes a bit more normal. And it's really interesting when I work with investors and I talk about future growth and say we use a conservative growth rate of 5%. And I say, okay, well, in 15 years, that property worth $500,000 is going to be worth $1 million. People go, no, I can't believe it. Yet if you go back 15 years, that same property was probably worth $250,000. And so when we're looking back, it seems normal back then or it seems cheap. I guarantee you 15 years ago, these same conversations were being had just in a different way.
And a lot of people are probably thinking, well, have I missed the boat? And for anybody watching the video version, we're going to put up a nice graph across your screen of how house prices have changed as a percentage over the last 27 years, or from 1993 to 2021. We'll also, for anybody listening to the audio version, listening to this as a podcast, we'll also link this in the show notes because what you want to look at is you want to graph, well, what is the annual percentage change in house prices over the last 27 years. So we can see that trend. So we can take out whether house prices were cheap or expensive at one point in time and say, well, what were the percentage differences? Because this will give us a real sense of how house prices have changed during previous booms. And here's the key point I want to say. House prices at the moment, they've been increasing at a rate per year of about just over 20%, maybe 21%. Now, that is enormous growth. Do not get me wrong. But if we look back at the 2003, 2004 boom, there was a period where at their peak, house prices were increasing at about 24% per year. So we had even more frothy growth back in the 03, 04 boom than what we've even seen today. So even though it may feel like, man, things are out of control, we have seen this before. We haven't seen house prices increase at the same dollar value, 100K or 110K, but we have seen them increase at the same percentage value. And a lot of people are probably thinking, and we had this conversation this morning, Andrew, have I missed the boat? Have house prices gone so far, it's not even worth me investing now because I've missed the boat? First of all, tell me whether that's true in comparison to these previous booms that we've seen.
Well, when you look at the last spikes in the market, like this, you go back to 03, 04, the growth peaked in March/April of 04. Now, after that, growth declined, but it was still increasing. You were still getting increases. So between 7 and 15% year on year, right up until the 08 crash. So you still had 4 years worth of capital growth. It was just between 7 and 15, not those extreme percentages.
Just 7 and 15?
Yeah, just 7 and 15. Which I mean, I'd be very happy if I was getting 10-ish% a year on year. That works out not too bad an investment. And then at the 15-16 spike, the growth peaked in September 2015. And again, the growth declined after that, but it still continued increasing between 13 and 15% for another 18 months. So, I mean, you could have, assuming that we were at the absolute peak of percentage increase now, you might have between 18 months and 4 years worth of this growth carrying on, just not at the same percentage growth as we're seeing today.
And in fact, I believe I saw that the Reserve Bank of New Zealand had said that over the next 3 years, they're predicting an extra 20% worth of house price growth. So that'd be an average of about 6% compounding per year. So we're still expecting to see, quite extreme or quite a lot of house price growth even into the future. And remember, they're the ones who are meant to be putting in or are planning to implement policies that are going to slow that down back potentially. Now, as Andrew said, when you just look at a graph of house prices and what the actual dollar figures are, they're always going to look scary because they are exponential in nature. If you look at any graph where something's increasing by 3 or 4 or 5% compounding year over year, then you are going to see that exponential kind of graph or movement. So that'd be the same if we looked at incomes over time, we'd see exponential movement. If we looked at wealth over time, we'd see exponential movement. If we looked at anything that's increasing by a percentage amount every year, we'd start to see that. So when you apply that to house prices, you need to keep this in mind. It might look unsustainable. This is how house prices tend to move. I don't think that over time we will look back and see that house prices at their current dollar levels are unsustainable. But let me ask you this, Andrew. How does this boom feel compared to previous ones you've been involved with? Because I know you've been in the investment market a lot longer than many of the people listening to this show.
So I was saying to someone just the other day, this is starting to feel a little bit like 04, 05 kind of time, where the market was starting to run hot. I do think in some centres, you're still just getting that catch-up growth. I do think it's the tip of the iceberg. I think there's heaps of opportunity. But I do notice things in the industry at the moment that make me feel a little bit nervous. One of those things is developers' funds that they're raising now. That feels like the new finance company collapse for me.
So just explain that for anybody who hasn't seen this.
So you might notice on Facebook or Instagram, a lot of developers, because banks are getting so hard right now to get development funding, they're going out and sourcing their own finance from the public. And so long as you're a wholesale investor, you can choose to invest your money at a rate of 10% per annum paid quarterly for most of them. And it is extremely high an interest rate. And remember, with high returns comes high risk. The two are intertwined. And someone actually rang me about this the other day and said, "What do you think about this?" And I answered it very easily by saying, "Well, you're not actually probably a wholesale investor. You can't be investing in this. You have to be a wholesale investor." But second of all, you've got to ask yourself, if someone's paying 10 times the rate of return as a bank,
More like 12 times.
yeah, is it high risk? And the answer is absolutely. And so that investor won't be putting any money there. And I just think it's probably going to be the next thing where there's going to be some challenges, and there might be one of them that struggles over the next wee while, or can't pay out that return, and then all of a sudden people get a bit nervous. It feels a little bit like that to me. That's what sort of looks similar. I guess the things that are different now is that the government is very involved in banking, more so than they used to be. So through the Reserve Bank, I guess, so kind of indirectly but directly, you've got all these mechanisms in place to make sure banks are resilient in the event of a negative correction. And that's because of the 07-08 crash. And so I think that we're a lot more protected there, and people probably don't have the same level of debt as they used to.
But in many ways as well, one thing that I want to talk about is people often get worried that there's going to be a major crash in house prices. One thing, because we did see a crash in house prices by about somewhere between 5 and 10%, depending on where you lived during the 07-08 crash. Now, a lot of that was because banks didn't have the liquidity to lend. Now, if the Reserve Bank of the government are regulating financial institutions to make sure that they are more resilient, that means that if steam did come out of the market, house prices are much less likely to fall today than they were 10 years ago.
Yeah, I also think the other big difference is there is still a major shortage of properties, particularly in the rental market and particularly in certain areas like Wellington. So there is a need for new stock still, and even if the market slowed down a little bit, investors slowed down, as an article in the newspaper at the weekend, Tony Alexander was talking about the LVR restrictions kind of slowing down that market a little bit in the investor space. I expect there to still be a lot of upward pressure on rents. So you could tolerate things like an interest rate increase. Interest rates, I still believe that they're going to be low for a long time, so I'm not really concerned about those. I do think just the biggest change this time around is the government is far more involved than they previously were. And the number one thing that controls housing is finance. And they've kind of got a relatively good handle on that.
Now, the question that a lot of people are probably wondering is, okay, if what we are seeing today is what was seen in the past, realistically, in that 03-04 boom, have I missed the boat? If we are kind of peaking now in terms of the percentage growth per year, have I missed it?
So I don't think it would be wise to ever think that you know what the market's going to do tomorrow. So I don't profess to know exactly what's going to happen tomorrow. My prediction is that you've got a couple of years, maybe between 2 and 4 years worth of steady growth in New Zealand, not 20%, but maybe 5% on average. I think that that's going to continue. However, if it doesn't, that doesn't matter if you're a long-term investor. If you're wanting to buy and hold long-term, I think you can pretty consistently say, well, yeah, you're going to have growth. But I don't think that anyone's missed the boat if you're getting in now. I think personally, 2 to 4 years worth of growth.
I certainly think that the people who have received the most growth, particularly in a market like Auckland at the moment, are those people who invested when the market was flat. Yes. They have seen all of the growth because they invested before the market started getting bubbly and house prices started taking off. So I always think the people who get the growth are the people who actually buy a property in the right area and in the right circumstances and hold it for the longest time.
Or people that just do it.
So how does this boom compare to previous booms? Well, it looks like we're at the start of it. We'd expect some of that growth to level off. But remember, that growth is in percentage terms. So even if your house is increasing at 10% per year, you're happy. You've had a slowdown because instead of driving at 200k an hour, we're now driving at 100k an hour, but we're still moving forward. We're still getting that growth that you're after as a long-term property investor. Hey, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you'd like to meet us in person, we are hosting property investment dinners in Auckland, Christchurch, Wellington, and Queenstown. We are holding a draw for these. How to get enter. First of all, follow us on Instagram, share us on your story or in your feed, and please leave a review in your favourite podcast listening app. Take a screenshot, send it to podcast@opuspartners.co.nz. That's how you get in the draw. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.